Good evening, this is your friendly Trader 72. Welcome back to my YouTube show. I hope you are well on this fine Thursday evening. It's been a lovely day today. It was blue skies in London, sunshine, 16 degrees. I hope some of you may have got some good reads out of that because I certainly didn't. I was working from home all day. The markets never sleep, as they say. And it was one of those days, a red day today indeed. But I'll come to that in a minute. Let me just give you a quick idea of what we are expecting today on today's evening diary show from Trader 72. It's news first with value investment and just a quick explanation on value investment. Followed by analysis on Visa as well, which will give you an idea of what I'm looking at when I'm looking at a stock. I know I did that yesterday with S&P Global, but always good to reinforce a few ways of working and just kind of go through it again, which I will do throughout this show in terms of what I'm looking for. This is really mostly, as I said before, for retail investors or small retail investors that have just come into the play, or maybe medium experience as well, just to recap on things, and also just give you a kind of a different way of investing. There's so many ways of investing. I've tried pretty much a lot of them over the last 11 years, but this one seems to be the one that suits me best in terms of what I do outside the trading as well as when I'm actually trading itself within the markets. It gives me that freedom a little bit in terms of just constantly checking on stocks. That value investing is a long-term, a longer-ish term situation. So without further ado, let's get on with the news very quickly. We'll rattle this through. Jobless claims, 213,000, expected to 15, which means that there's an indication of layoffs are still very low in the economy in the US. So at the moment, yes, it is a sluggish labor market where there's not a lot of hires, but there's also not a lot of firing either, or obviously representing obviously those numbers. So it's not many layoffs. That's the word I was trying to find. It's been a long day, so apologies there. So not a lot of layoffs, but also not a lot of hiring. So it's a sticky market at the moment, although we do know that the US economy is stronger than expected. Private payrolls came in high yesterday. And again, the unemployment figures came in quite lowish or within what we expected. So that's that from there. Obviously, we went through already this morning with the morning diary about the Fed's not cutting interest probably for another few months. I think it's going to be about maybe at best 2 or 3 interest costs this year, if anything. But that will obviously depend on the situation with the US economy and how much it hots up or not. We have got some geopolitical issues. Again, obviously, we all know about the Middle East. I've kind of well documented that this morning. That's the major takeaway of the day. And I think pretty much this week, there is an ongoing, it's the 6th day now, conflict with Iran versus Israel and the US. The bombing keeps coming. Even so, we've reached the situation where the current regime in Iran has been wiped out. There is still obviously some core supporters there who are firing back. So ongoing stuff going on there with the conflict in terms of bombing and also warships being sunk and the port, and obviously the situation with the crude oil, which actually at the moment seems to be gaining momentum, it looks. So just looking at the chart here, US 30 down 2% today, so quite a lot, 1,000 points down at the moment on the US 30, which is the US 500, S&P 500. Nasdaq seems to be weathering that better, thanks to Broadcom mostly, which has jumped on strong AI chips revenue forecasts, so that's done quite well today, and I think that's kind of given momentum to the AI software companies as well, because I've seen that with my Adobe today being up nearly 3%, although I will come back to that in a minute in terms of why. Middle East conflict raises inflation concerns. That's probably the main takeaway of today, I think, and that's probably why we're having obviously energy stocks edge up. That's obviously good for energy stocks, but crude oil at $86 a barrel is certainly picking up, so tension continuing, and I think hence why a red day across the net here. So let's move on to, that's the news for today, and I think we've kind of well documented that this morning. So let's move on to what is a value investor. Now, value investing is something that I've fallen into the last 12 months. I've kind of read specifically Rule 1 book by Phil Town, which I particularly liked, and I think I would advise for anybody to read it if they're not sure about value investing and understanding it a little bit more. I can only give you a brief kind of, obviously this is a show that we don't want to bore you to death with it, but I will give you an idea of what value investing. So as you can see from the screen, value investing, it's basically looking at undervalued stocks that are basically you can, depending on what company you're looking for, mostly for me are big cap companies that have had a few issues, potentially, few stories going around them, a few rumors, maybe that's damaged them, as Microsoft with the capex, maybe the fact that people are rotating out of tech companies at the moment. So various different reasons why. So it's a bit like you guys, shopping in a shop. You want a great shirt which is worth £100 and you're going to wait for it to be at a discount to buy before you buy it. That's basically the idea of it. So as you can see, the price, so they look at for undervalued stock where the price is lower than what the company is truly worth. They focus on the business itself, not short-term market moves. That's an important part of it, to ignore the news there. Sorry, my chair is actually slowing down, or falling down, sorry. They study basically, I do as well, earnings, cash flow. Cash flow is obviously the all-important part, the FCF, the free cash flow as well, versus the debt of the company. Obviously, any company that you choose that are seriously leveraged, I would stay away from, as long as they can pay back their debt fairly quickly. And there's another way of trying to find that, which will be under the financial matrix side that I'll show you in a minute. But that is obviously a key important part. And obviously the competitive edge, the moat, the understanding, the growth prospect of the company is also very important, which comes with the moat, which obviously the stronger the moat, the stronger the market, meaning the stronger the value of the company in terms of what market it's in and the dominance of that market, the more the value of the company will obviously go up if there's any issues. And obviously the growth of the company over a period of time. So that is what the basic idea of value investing is, to buy companies at a lower price than it's truly worth. And that brings me to obviously the intrinsic price that I've mentioned a few times. And the intrinsic price is basically the actual true price of the stock based on several different models, but the one I like to use is the DCF model over a period of 10 years. So that's the free cash flow that the company makes for the past 10 years to the forward 10 years. So we're looking at 20 years expansion really effectively. And you have to have an idea of, based on historically and also on what the company can achieve, the growth of the company. So I'll come to that in a minute in terms of explaining a bit more about the intrinsic price. But the intrinsic price is what is key here as a value investor. From there is a thing called the MOS I've mentioned to you guys quite a few times, which is the margin of safety. And the margin basically the description is a buffer between the price and the intrinsic price to protect against losses. So the more you buy at a discount off that price, the better you will be in terms of losses. So if the stock was to take another pounding, you already know that you got the stock at a discount of possibly 25 to 50%. And unless the company, it goes to zero, you are safely, well, I could want to say that a safer situation than being at a company that you just bought at overpriced, which falls 50%, and then you end up having to wait for 2 years, for the company to get back into a rhythm. I did that similar mistake with Adobe, which actually reflects my portfolio as a mistake. And I did say to you guys, I am not going to BS you guys any further. This is the truth of what I do, as in there's no gloss on this. This is the true happenings of a small retail investor and a trials and tribulation of what may happen when you buy too quickly, or what you call a falling knife, which is what happened with Adobe when I bought it at 10-15% of its discount. I thought I did enough, but actually it turns out that really 25-30% is probably a safer bet. You can go up to 50%, but rarely does a big stock fall 50% off its actual intrinsic price. But anyway, I'm diversing now. I'm diversing to another dimension here. But this is the basic idea. So you buy a stock at its proper price and then you discount it off that. And that's what value investing is. Now, it's not just as simplistic as that. There's also the story behind it in terms of the company history, understanding the company and what it means. So it brings me up to the next section, which is the 4 M's, they're called, under Phil Town's book. I have it on my board here and I have it on my computer. It's just a reminder that there is a criteria to use, not just the numbers. You've got to understand the story behind the company and also understanding the business. And that's one of Warren Buffett's biggest things, is to understand the company. He never buys into a company he doesn't understand. Now, depending on how well you understand certain markets, that's up to you, obviously. If you're a specialist in AI or you're a specialist in consumer cyclicals, that is your thing and you'll understand it better than anybody else. So understanding the company is the most important thing, hence the word meaning. So is it recession? Is it a high switch cost? Is it a global scale company? That is the main thing. So you've got to understand. So in terms of Visa, as the analysis I was giving you about analysis of Visa here, it's understanding that it's obviously a card holder, a bank, a merchant. It earns fees every time you use a credit card. So that's kind of thing that we mean by the meaning, explaining what the company does. Once you understand that, then obviously you can tick that and move on to the next one, which is the Moat. So the massive card network, it's got over 150 million plus merchant location worldwide. So that's how many people use it. It has very high margins, a huge network effect, which means that it goes from one person to another, to another, to another, and they use those credit cards. So the layer of people using that, which is a very strong moat. You want a strong moat or even a medium strong moat, which means that the company will continue growing time after time. And obviously, a difficulty of how a rival can compete against those credit cards. There is actually a little bit of competition, ironically, on Visa at the moment. They're trying to do that, but whether or not in the long term, Visa and MasterCard have got such a strong hold in that market, it's very hard to see it happening. But you never know, but it is a strong moat. So that ticks the market. So again, a strong moat and understand the meaning are two key points. Moving on to the next thing once that's ticked, if they don't tick and if they don't reach that criteria, then there's no point going. That's my opinion on it. Even if one is not quite right, I will put that on the back burner, potentially. Management obviously is important, understanding the management and who's managing the company that you're investing in. Some of the biggest value investors have lots of money and billions of pounds, will obviously go and meet the management and understand them, but as a small time retailer, that ain't gonna happen. So therefore, I have to work out from information on ChatGPT and other meanings to understand where the management is coming from and understanding what they're going to do with the company going forward, what their background is. So all this is again part of the research of looking for the right people running the company, and you feel confident these people will take the company forward. Once you've worked that out, then it becomes the financials. Now the financials are the key point or matrix of a company that I like to invest in. It has to reach a certain threshold. So the return on equity there in the middle needs to be almost between 10 and 12% at least. There's no point you investing in a company that doesn't return more than 10%. And as you can see for Visa, it's got 54%, a humongous number. Profit margins, I would consider maybe gross margins. Obviously the overall profit is important, but again, well over the threshold here of 12 to 15%. It's at 50%. Market cap is important. That's the entire, what the company is entirely worth at $606 billion. Now you want to kind of transfer that across, not transfer it, but compare it to what the debt is like. So what you call an EV. I will show you again in more detail. The EV is the debt that company is carrying. So if the debt is obviously higher than the cap, it means that they are obviously in leverage of cash and they are in debt of cash. So obviously then you're going to work out what is their free cash flow, and the free cash flow will detect whether or not they can pay that debt quickly, and you want it to be under 3 years or even less than that if possible. In Visa's case, that is obviously the case because their debt versus equity, which you see there, is under 1 and is clearly can be paid back very quickly. The other thing to obviously cash is the free cash flow, which I keep harping on about. I'm sorry if I bore you to death with that, but that is the key point of value investing, that the company has a huge amount of free cash flow to basically reinvest. It is the lifeblood of the company in terms of moving forward. I can give you, again, if you prefer, you can ask me questions on the comments below in terms of free cash flow and what it means. I can give you a description of that in later videos or shows, whichever way you want to call it these days. So that's the financial criteria that needs to be passed. Once that financial criteria is passed, then we move on to the intrinsic price, which I've already delved into in terms of working out. Now, the free cash flow, the intrinsic price is worked out on a free cash flow situation with various different ways. But the DCF model is how you work a free cash flow. Now, I'll give you a quick example. I did that yesterday. This is discount, the Visa currently, this is on somebody else's discount flow, but that gives you a quick idea of what it's about, a more clear view. So the growth of the company is what you're going to be playing with in terms of number. Now, you could go stratospheric on it if you want, but that won't give you a complete view of the intrinsic price based on history. The CAGR, which you see there, is the average percentage over a period of 10 years and 5 years. That's the compounding idea of what the company can make over that period. Now, over 5 years, they made 10%, and over 10 years, they've made 18%. Now, you could go for a very conservative 10%, just under that 5 year, because obviously it's slightly dropped on the 5 year case. But I think realistically, over a period of 10 years, 18% is quite reasonable. I think you've got to aim for that middle part. Now, the intrinsic price is all about what you think the company is going to make in terms of percentage, or realistically, not just what you think, but historically as well. And you've got to be reasonable. Don't go over the top, but also don't go too conservative, because it will fluctuate. But it is an amazing way to find out what the company's worth is based on its free cash flow. So this is obviously based on the last 10 years, from 16 to 25, and then from 26 to 34, roughly 10 years. I mean, it's 10 years altogether. So this is what the free cash flow will be and what we think it will be. So obviously you have to forecast that amount over the next 10 years, and that is a hard thing to do. But obviously that is why you have a discount rate on the free cash flow. So it gives you, it kind of averages it out. So a discount rate over the next 8 years is normally between 8 to 10%. And a terminal rate is beyond the 10 years, because obviously you can't keep discounting, because you won't know what's going to happen beyond 10 years. You probably won't even until 5 years. Some people like a 5-year DCF model. I prefer 10 because it gives you more of an overall picture. So in this instance, I think potentially a terminal value of between 2 to 3% is about right. Now in this instance, in this model, it's 3%. So going into the medium rate growth, that gives you a value intrinsic price of $417, which gives you roughly about a 23% discount on Visa, which again, as I said before, you minus the discount off the intrinsic price. Once you know where that intrinsic price is, which is between, personally, 25 to 30% is probably the right one to go for. Even at 23%, let's not split here, 23% is pretty decent, especially for Visa, who, well, if there was to go down below 50%, would be a disaster. So the chances of that happening are quite low. So you've got to kind of look at what company you're investing in and be reasonable in where you think the discount will be. If you wait for a discount of 35, 40% discount on Visa, you could be there forever and miss out on, nevertheless, a good dip. So the upside there, it says 36%, obviously, to the 417, but it is actually a 23% discount at the moment as it stands, based on about 306. But obviously, the market value has gone up to 318 since then, so you're probably looking at 22% discount. The reverse DCF is something that shows you that where the stock is, the actual DCF model is at and where it can go to. So if it's 12% and it's only 7.70%, that means the stock is cheaper. So it gives you an idea of the current DCF model reversing back. Again, I can give you more of a description about what it means in the future. And again, please do comment below if you want to know more about the reverse DCF. But it does give you an idea of what the growth could go to based on 12% or even 10%. So there's room to grow there. So that's the discounted cash flow model and how it's worked out. I can go into more deeper side of it if you want to, but as I understand it, that is the way it works. It's, again, a very simplistic way of explaining it. I can go into more details, or even you can find a book and value investors that can probably explain it into more details. But this is what I think is the best model to base your intrinsic price on. There are other models based on EPS, earnings per share. But again, please be my guest and try to, if that's what you prefer, then obviously look for that. So that's where we're at really with this situation at the moment in terms of that. Now, the final really quick note in terms of currently on Visa is to kind of work out why Visa is where it's at. So please do your research in terms of history of why the stock is potentially dipping or is at discount of its intrinsic value. As Visa's, like many companies, there are many different situations where there's regulatory and legal pressures, which a lot of companies do go through all the time. Nothing unusual there. Cost and margin pressures, competitive and structural threats, potentially. The big one for me, I think, for the credit cards at the moment is a reason why they're struggling at the moment, which is quite rare because normally MasterCard and Visa normally should be around the 350, 360 mark on average, is the fact that Trump wants to cap the interest rates on the card to 10%, which obviously would be disaster for credit cards, but also for consumers. So whether or not that will ever be implemented, we are waiting for an answer from that. And I think that's what keeping a big cloud over the credit cards. So again, do your research in terms of any company you buy in that might be dipping. It's a key point, as important as the fundamentals and the 4Ms, which I've just described, the criteria that you guys come up with. Please do come up with your own criteria. Don't just copy mine. I'm sure you can. I just think you should do your due diligence in terms of that side of it. So that's this is just advisory, obviously. So in terms of that, that's probably why the companies, and also there's a lot of geopolitical affecting risk management as well with credit cards at the moment. But again, as I said, it all marries up. It's the story behind the actual numbers. That's what you want to marry these two together and work out where the actual price of the stock or the company is at, and that's really important. So that's the criteria of value investing: intrinsic price and margin of safety. Hope that makes sense. If not, please do ask me questions and I will answer to my best of ability. Moving on to the last part of the show tonight. I think we've done quite a bit of waffling. I hope I haven't bored you to death yet. It's been a long day for everybody, I'm sure, is the situation with my stocks and shares. Adobe apparently has been bought out by the man, David Michael Burry. God, it's been a long day, I can tell. Michael Burry is bought into Adobe on official rumors, and there's a lot of rumors in the market, so be careful of that as well in terms of rumors and where you're at, because I tend to believe everything initially what was said, and sometimes you've got to take things with a slight pinch of salt. But in this instance, it seems to be quite strong because the stock price of Adobe has moved by 3.5% on the day. So it's moved above 280 for the first time in a while. It was at 250 at the beginning of the week, so clearly a big move up since then. But Michael Burry obviously is a short-term buyer, so we're not sure exactly why. Obviously, he's now gone private, so it's very hard to tell if he has or not. He's no longer a public hedge fund or investor. So it's based on rumors at the moment. But why not? Michael Burry does like a stock that's at a good price. And in his own way, he's a value investor, maybe more of a short term. Actually, if anything, Michael Burry is probably more of an investor like me, where I like to buy stock for up to 6 months to a year or 6-7 weeks, depending on what the criteria is and what the strategy is. But anyway, I've already gone through that last night. So Adobe got up, which is good, and my S&P Global has weathered the storm. Touch wood, so far it has done really well. It is a defensive stock. It seems to be recuperating nicely from where I bought it at 435. I actually wish I'd bought more now, potentially, but you can never know when you buy an entry point. I was going to buy on the dip thinking it would drop, obviously, with the current tensions of the market, but it hasn't, and it's held up well, and currently at £150 profit. I know it's minimal, but it is a minimal entry point. So everything is relative, and as I said to you guys, I would not BS you in terms of what I'm doing, where I'm at. And that is transparency for any retail investor. So I hope that is what you guys want to see. Obviously, hopefully it will be, but it is what it is. So at the moment, 450 is in a good spot for S&P Global. And as I said, if it does go up north of 460, I may well buy more. And if it falls back then below 435, maybe even around the 425, 420, I would obviously buy more stock. In the meantime, I've still got money on the side to buy more stocks, or deposit money to put down to buy more stocks. So it's waiting on the sidelines. I've been sitting on my hands even since the show started this week, really, and waiting to see what happens. I was very close to buying Visa this afternoon. It hasn't quite fallen to the price I want it, which is 314, but it is still a very attractive market share at the moment. Both MasterCard and Visa about 23-24% discount. Uber, I'd love to buy more, but I think I would wait for it to come back down. It's still at about 45% discount, so great price there. United Healthcare as well, but none of them have fallen into the price I'm really looking for. Microsoft is definitely something I'm interested in buying. Fantastic company, got caught in a headwind with this AI situation, but also with the CapEx spending. But it's still an amazing company in terms of Azure and the whole data storage and everything else that Microsoft has got. And I think it's probably at its lowest at the moment. It has been for a while. I think it's almost at a 2-year low. So it's a great opportunity to buy in. It's right off its 200-day moving average there, the little white line. And it seems to be bouncing off that at the moment. And looks like there's a curve on the Stoich as well. Anyway, all that to say that I'm waiting for the right opportunity to buy Microsoft, probably around more the 400 mark or sub that. Newsworthy wise, in terms of alarms, nothing much more's gone off apart from NatWest this morning. I've already gone through that. Adobe, Microsoft touched some of my alarms, but nothing else apart from that. And looking at the market before we go, it's still well in the red. So, last day of trading tomorrow. We'll be back for a morning diary show and an evening diary show. I hope you've enjoyed. Please subscribe and like. I would be much appreciative. I'm trying to get this off the ground. If anything, as I said, I'm doing this for myself as well because I enjoy recapping on the day. It's cathartic for me to help me to kind of reflect a little bit, even if I'm talking to myself. But hopefully I will get a few more viewers, so it'd be greatly appreciated if you can subscribe and like, as I said. Tomorrow's the last day, so I will see you all then. I hope you have a great evening. I'm exhausted. I'm done for the day. I'm going to go and retire with my girlfriend and have a bit of food and enjoy the evening on the TV and be fresh for the morning. It's Trader 72. It's over now. See you all tomorrow.